Hey, what's going on, everyone? All right, look, investing has been made so easy with all these apps, websites, or, great YouTube channels. But when you look at some of the websites, you see all these green and red bars and you might get a little scared. I mean, it looks more like an EKG machine than it does stocks. Like, am I alive? Am I dead? But I want to confirm that you're not dead by smashing that like button. And if you hit that like button, I can confirm you are alive. And that multicolored bar chart that you see going up and down, kind of like an EKG machine, all it's doing is telling you exactly what the stock has been doing. All right, today I'm gonna explain those bars, actually called candlesticks. And I'm gonna let you know some of the strategies that pros use to identify some trends. All right, let's get at it. And the reason it's called a candlestick is because it kind of looks like one, only with the wick on, not just on top, it's also on the bottom. The thing is, these candlesticks are representative of a time interval. So they could be set for a day, they could be set for an hour, they could even be set for 1 minute. So if you look at a 1 hour chart with these candlesticks, each candle is representative of 1 hour. Makes sense, right? Let's look at an individual candlestick and what it's made up of. First, you got the body of this stick. Now this is the price movement from open to close of the stock price within that time interval. Then you have the wicks that are also called the shadows. And this is the price movement that happened outside of the open and close within that time interval. So if the candle has a top wick, that means that the stock had a high above that open to close interval. Then if the candle has a bottom wick, that means there's a low that happened outside of that interval, right? All right, let's look at an example. So say you had a stock that opened up at $3 a share, and right when it opened up, it went down to $2. And then throughout that time interval, it went up to $5, and then came back down and closed that interval out at $4. Now you would see a candle with the body being between $3 and $4, with a wick at the top that was $5 and at the bottom that was $2. And since that candle actually went up in price, that candle would be a green candle. Inversely, if it went the other direction, then it'd be a red candle. All right, now that we know the basic understanding of what a candle is, let's look at some of the strategies that traders look at when looking at these candles. Now, I want you to keep in mind, these are basic strategies. There are a ton of patterns and strategies that traders look at, but these are the 3 basic ones. And the reason I'm doing this is because this is an introductory video. I don't want you to be like, oh my God, like these are so simple. I can get way more complex stuff elsewhere. Like, no, this is for the beginner. And with that being said, we're gonna look at the first pattern, and that is the hammer or the inverted hammer, depending on which way it's going. The hammer is when you have a candle with a very small body and then a wick, a very long wick on one side, and on the other side you have a little or no wick at all. And the hammer can signal the bottom of a trend. So if you're looking at a whole bunch of red candles and they keep going down, and then all of a sudden you see a hammer, that may indicate that there is going to be a reversal. And then if you see an inverted hammer, that means there is significant selling pressure, but not enough to drop the price below the open. And then the next trend we're gonna look at are called the 3 soldiers. So obviously, I mean Iron Man, Thor, and Captain America, right? No, I'm talking about 3 candles that are substantially sized and all the same color. And what this signals is a continuation. Like if you see 1, 2, 3 of red candles, that means that there's a continuation that, yep, the trend is going down. And with that downward trend, you might want to wait just a few seconds to hop in. Or on the other side, you're gonna see an upward trend of green candles with these 3 soldiers, and you're gonna be like, oh, okay, it's trending up, but it may signal that there may be a cooling off session coming up. So you might wanna wait just a second. Or if you're looking for an exit point as these 3 soldiers are going up, it may signal that it's gonna top off soon, so selling it probably wouldn't be too bad to do. And the thing is, when you see these 2 sets of soldiers, these are good to follow because that means there's going to be something happening very soon in the market. So then you can time it right, depending on what you're trying to do, buy or sell. The next pattern I'm gonna talk about are called confirmations. So many of the indicators that you can use can identify a trend, like what direction is it going? A confirmation is where you can confirm that trend is going in the direction that you are anticipating. So, for example, if you see the 3 soldiers, red soldiers, and the next you see is an inverted hammer, you might think that it is turning around. But it could be a fake and it could go back down. And then you see a green bar, you're like, okay, followed by a small red bar, and then you see a large green bar, and you're like, oh, yep, this is it, that's the confirmation, let's hop in. So the entry point to this confirmation would be when that second green bar goes above the red bar. Okay, I know these three trends are pretty basic, and yeah, they are, but they're really for looking at very small amounts of time. Now let's look at much further out, much bigger timelines. And the way we can look at candles to look at longer time periods is to put trend lines to these time periods. The two trend lines I want to talk about are the support and the resistance trend lines. And really, they're pretty simple to draw. All you do is take the chart, and for the support line, you draw a line from the bottom of each of these little valleys, and you can kind of project out where the support line is going to be. And for the resistance, you pretty much do the exact same thing, is you draw a line from peak to peak, and those two lines kind of create the trend line canal. And typically, the stock price will bounce between those two lines as it continues on. What you'll see is a trend where as the stock price approaches that resistance line, you'll see the selling volume will increase where the buying volume pretty much dries up. And this will cause the stock price to drop toward the support line. And then you'll see the buying volume increase where the selling volume starts to dry up. And thus the stock will then rise until the inverse happens, and so on and so forth as it goes in between that canal. So the stock will continue in that canal and then eventually break through one of the lines. If it breaks through the resistance line, then the stock price will shoot up. After the stock price has shot up, the resistance line now becomes a line of support for when it comes back down. And of course, if there is a breakthrough, you should probably wait for a confirmation before you hop into the market, just to make sure that it is going through and it isn't just a false peak. And if the stock was to break through the support line, then usually that's a sign of something bad that happened in the market. And as you can expect, with that result, breaking through the bottom means the stock price will probably drop pretty far. Either way, if there is a breakthrough, there's a new pattern that will emerge, and that old pattern you can probably just toss out, except for having those lines as the new support or resistance line depending on the breakthrough. But I want to point out, these are indicators, and by no means are they guarantees. If I've learned anything from investing, is the market will do what it wants. Many times I've seen it where the market is indicating going one direction and then goes the complete other direction for reasons unknown to me at the moment. But you know how traders get like the news right when it breaks. So I'm not privy to that close of information. Like in more recent news, a Chinese real estate developer has pretty much gone under, and that caused a lot of shakeup in the market and kind of made it drop a little bit. The thing is, timing wise, the S&P 500 looked like it was just bouncing off that support line, and then when the news came out, the perfect market when it was about to hit that support line, it broke through and caused a pretty significant drop. But I want you to remember, stock investing is a get-rich-slow game. So over time, it will probably go back up. But what I want you to do is check out my last video where I talk about the key metrics that I look at when investing in companies to make sure it's a good company that's gonna last the long haul. And the thing is, candlesticks are great when trying to time the market for entry and exit. Hell, day traders use them religiously, but for new investors, I wouldn't recommend day trading. Not at all. But for more information on stock investing and other side incomes like real estate, go to insidevesting.com, and please do not forget to like and subscribe. I'll see you later.